Okay.
it's not going to be a complete perfect transcription, but
It's fine.
well, hopefully the recording is on now.
Okay.
So I guess the first question really is to get your perspective on how MiFID II is changing the landscape for research payment and research procurement. So where do you what's your perception on where we are with that?
Well, certainly MiFID II, from a European perspective, is potentially changing significantly the methods of that the buy side will have available to them to pay and ultimately fund research, and some of those changes are potentially fairly onerous from an organizational and workflow perspective, and many of those responsibilities are squarely on the shoulders of the buy side directly, where historically, when you think about how research has been paid for, it was a very collaborative process between the buy side and the sell side, even, because ultimately you were using either a transaction and using that transaction specifically to pay for research at that executing broker, or obviously using a CSA. But in either one of those examples, the sell side's very much involved, and the infrastructure and ecosystem, if you will, across the industry is very much involved, especially when you get down into the CSA world, where an asset manager had CSA brokers, and sometimes that asset manager would leverage aggregators such as ourselves and other solutions that are in the market. And all of that was designed and has been developed over years to really make the process work fairly and seamlessly, and took a lot of the burden away from the buy side specifically. So now you pose that with MiFID, which is putting much on the buy side potentially. So the three methods primarily that are available to them going forward as a result of MiFID is paying for research out of the asset manager's own P&L, and clearly in that example, the sell side, other than obviously pricing research, they're really going to be on the receiving end of research payments, and aren't really helping in the process of funding or helping the buy side, with a system that's going to help them pay for research. So the buy side will need to have policies and procedures and payment methodologies and technology to support and track, a whole P&L system internally. So that's one method, shifts a lot of the burden from the industry as a shared kind of, burden, if you will, to the buy side. And then the RPA method, whereby the buy side would fund directly each RPA account. Again, sell side's really not involved in that process at all. It's something that the buy side firm would need to set up on their own, or by maybe outsourcing the administration of that process to a third party. So there could be vendors, obviously, that would step in to help the buy side in that. We're certainly positioning ourselves to be one of those vendors. But again, the sell side kind of not involved in that process at all. And then the third sort of way in which research could be funded is by, many would call the enhanced CSA model, which is leveraging existing and potentially new CSA arrangements that would be set up, but those arrangements would be tracked at a much more granular level, and there would be a lot of work that both vendors and the sell side would need to do in addition to what they do today to track commissions, research commissions, and payments, at that account level. But there, at least there is a bit more of a shared responsibility between the sell side and the buy side in terms of funding research and paying for research, and that is currently supported by a foundation of CSAs that exist that would need to be enhanced. A little obviously less burden on the buy side. As I said, it's a bit more of a shared burden on that third methodology of the enhanced CSA. But
Right.
So no matter which way an asset manager decides to fund research, I think you can make a case in almost every option. There is more of a burden being placed on the buy side to figure this out, and it potentially could be onerous for many organizations, depending on how they're structured, depending on their organizational, the way that they're structured. Number one, number two, the number of underlying clients they have. Whether they're a mutual fund company with individual mutual funds or separate account where they have thousands of underlying accounts. So there's a lot of dependence on the business model of the asset manager as to which method they're more likely to choose going forward. And that's, I think a process that many buy-side firms are going through right now.
Right.
So that's kind of how I see things kind of playing out over time. And that's just on the payment for research and how you're going to fund those payments. We haven't even talked about, all right, what do you need to do to get to that point, right? And that's where you get into research evaluation and consumption tracking and, a much more transparent process around all of that, which would be squarely, again, on the shoulders of the buy side to demonstrate that they have that process in place.
Right. Where there's been a lot of publicity in the UK about some fund managers. I guess there's 3 or 4 that have publicly said they're going to pay for research out of their P&L. Do you see that becoming a broad trend, or do you feel that these are more exceptional situations at this point?
Question, I would say tough to tell at this point, but I will maybe go out on a limb and say that it will probably be more firms than most people would expect. I think a lot of people expect that there's an economic disincentive for asset managers to, in effect, opt out and pay for research out of their own P&L. Well, what a lot of people aren't looking at is the other side of the equation, which is just the sheer magnitude of the challenges in setting up enhanced CSAs and all the client reporting and the tracking and the conversations and the hoops that you need to jump through in order to basically leverage the privilege of using the client asset to generate, funding for research. And I think this points out how onerous this MiFID regulation is, potentially more onerous than maybe the regulators had indicated or not. But it definitely has put in place almost an incentive for asset managers to simplify their life and simplify or unclutter the relationship that they are trying to manage every day with their underlying clients. This takes a major component of that challenge of managing those relationships off the table. And, so I think, when you look at some of the firms that have in this early process indicated that they're opting out, the structure of those firms probably lend to, in putting themselves in maybe an easier position to opt out. And so number one, I think it's partly an organizational structure issue. Secondly, I think it has to do with firms potentially trying to position themselves as being a leader with respect to transparency and best practice. And I think it's starting to set up a bit of a tier from a best practice client sort of servicing, transparent method where, if you opt out and you pay out of research out of your own P&L, you can make a case to your clients from a marketing and thought leadership perspective that you're taking the highest road. Okay?
Mm-hmm.
I think, I'm not saying that that's a true statement, but what I am saying is I think the firms that are opting out are going to position it in that way, that they're taking the purest or the highest road, which is, we're going to pay for research out of our own P&L. And therefore, everyone else or other competitors that opt for the RPA, where they're funding these RPA accounts by debiting assets from each underlying client to fund research, or they use the enhanced CSA, which then uses transactions ultimately to fund, an RPA account. Those other methodologies may be positioned as, less than pure, or, a slightly lower road than the highest road of paying for research out of your own P&L. So I fear what that will do is, and these are some of the unintended consequences that we've been speaking about, is that it creates almost peer pressure within the asset management industry to have that perception amongst your clients that you're taking the highest road, which is paying for research out of your own P&L. And therefore, that peer pressure will force more firms to opt out. And unfortunately, the more firms that opt out, I think the more that the industry will be challenged from an economic perspective to support, those smaller to medium advisors who really don't have either the resources to fund research out of their own P&L, the assets under management to fund it, the ability to outsource research if they can't afford to pay for research explicitly, and potentially does a bit of this unintended consequence that we spoke about, where the largest and best capitalized asset managers will be in the best position to opt out, to take that highest road, to leverage that perception to the clients, gather more assets, and it becomes this revolving circle where, the biggest firms get bigger and the smaller firms get disadvantaged, and ultimately it almost becomes a self-fulfilling prophecy that, the conspiracy theorists might say that the regulators have set up a system which potentially drives more and more customers into this opting out, paying for research out of your P&L method, and that ultimately, could drive a lot of competitors out of the business or out of relevance.
Right.
But we'll have to see how it plays out. I mean, I think the fact that several firms and pretty high-profile firms in the UK so quickly after the Delegated Acts came out made this decision, I think sets a pretty strong stake in the ground and a pretty high bar for others to now contemplate. And, we're even talking to large global asset managers here in the U.S. who definitely took notice of those moves in the UK and, are now starting to think, wow, well, maybe that's something we should be doing. It seems like from an economic perspective, in the near term, it may not be the best thing, but in the long term, it will, potentially position us in a better way, certainly uncomplicate, kind of our policies and procedures internally, and a lot of that sounds interesting and potentially interesting and potentially
the path that people might go.
Yeah, I was trying to think of almost as a way to competitively. It sounds interesting and competitively differentiating is the word I was looking for.
Got it.
Yeah.
Okay. Yeah. No, it is very interesting how this will play out in the U.S. TAB came out with a report, a survey they did, which indicates that 2/3 of the buy-side traders that they spoke with feel that they'll be impacted by MiFID II.
Right.
And I guess the question is, that you've
So that's
started
interesting
to touch
that
on is
it was 2/3 of the buy side traders, though, right? Not PMs or CIOs.
right.
That's interesting
Yeah.
because from a trading perspective, regardless of which path you follow, at the end of the day, the trader is responsible for best execution. And for most buy-side traders today that use CSAs, they've pretty well down the path of bifurcating the research decision from the execution decision, and this just, I think, solidifies it even further. So for buy-side traders to say that they think they're going to be significantly impacted by MiFID, that's interesting, just from the standpoint that,
it is interesting.
Yeah.
And
anyway.
One potential interpretation is that the expectation is that they'll go the CSA route more broadly, and although CSAs are widely adopted, the throughput on the CSAs has been 35-40%. So it could be that the anticipation is they'll be putting more trading through the CSAs going forward.
Right, where basically every trade you do it's got to be part of a CSA if you're going to use that methodology to fund research, right?
Right. Which was our expectation in terms of how things would go, but
yeah,
as you pointed out, the trend in the UK is in a different direction. So it'll be interesting to see how that plays out.
Right. And it is interesting too that the FCA, at least, maybe not more recently, but at least historically, was the most, the largest or the biggest advocate or proponent of unbundling, pure unbundling, paying for research out of your own P&L, and that was kind of a hawkish sort of position that they had taken historically, and they were sort of pushing the rest of Europe in that direction, and there was some pushback from several regulatory authorities and customers, primarily in Germany and France, that kind of pushed back. And that's how we kind of wound up at a little bit of this compromise, which seems to be enabling CSAs in this enhanced version to continue. But clearly, I think in the bowels of the FCA, I think they always have preferred, just cutting all of those other methods out and just basically paying for research out of your own P&L. I think that's been, their definite go-to position here.
Agreed. And do you get the sense that asset managers are waiting to see where the FCA comes out in terms of their draft of the regulation implementing the delegated acts?
I don't really get the sense that people are waiting and seeing anymore. I think there was a definite wait and see sort of cloud hanging over before the delegated acts came out. But as a result of those delegated acts coming out, I think everybody has a clear indication of what methodologies are in front of them. There's still some questions around the fringes, but once those questions are answered, I don't think it fundamentally changes, like, ultimately, the three choices that we've already described. And the fact that, some significant household name UK asset managers have gone public with their indication of opting out and paying for research out of their own P&L seems to indicate to me at least that there's not a lot of ambiguity or uncertainty. People are starting to make decisions, that will impact their business model and their competitive positioning significantly. So I think people are starting to make decisions and, set themselves up for whatever method they're going to be leveraging.
Right. You mentioned earlier that market is positioning itself to be an administrator. Can you provide some more insight in terms of what you're doing in that regard?
I can, at a high level, I can, just because it's a competitive market and we don't want to give too much information away as we're starting to really get into deep discussions with customers about our platform, kind of how it's positioned today and how it will be positioned going forward from a MiFID perspective. But fair to say that we're deeply involved in a MiFID-like workflow already, given the combination of our research aggregation platform, our broker vote capability, our calendar, which tracks interactions between the sell side and the buy side, and then ultimately culminating with our commission manager. Each of those products has pretty significant market share. We're serving some of the largest asset managers globally, and in preparation for MiFID, what we're basically doing, in summary, is we're lifting each of these products, and by lifting I mean enhancing features and functionality, and then integrating them more tightly to create a workflow solution that will enable the average asset manager to track consumption, evaluation, and ultimately payment, using and leveraging the technology embedded in our product suite. And so we're well positioned. We're doing that already for many of our clients. And there's, as I said, some features and functions we will need to enhance in order to provide the flexibility that customers will need with respect to the three methods that we've talked about, whether it's paying for research out of your own P&L, paying for research out of an RPA directly, or paying or funding RPA accounts through an enhanced CSA. So there's some features and functions we'll need to enhance and build into our platform that we're well on the way of doing. But in a nutshell, that's sort of how we're thinking about it.
Mm-hmm. Okay. Given that your commission management capabilities, you offer a CSA aggregation, virtual CSA aggregation. Is that something that you think will be increasingly valuable in the MiFID II environment?
I don't know if it will become increasingly valuable. I think it will continue to be valuable for those customers who continue along the same path, and for those customers that potentially use the enhanced CSA model to fund RPA accounts. But so we feel for those two groups of customers, our current model is very well positioned, and as I said, there's certain features and functions we'll need to enhance, just like many of our competitors will, around enhanced CSAs, so that we can track, more granularly, not only payments, but the commissions that are funding these RPA accounts at that customer or account level. So there's some enhancements we'll need to make there. But when you move more into the paying for research out of your own P&L or funding RPAs directly, which really doesn't involve the sell side at all, that's really a buy-side specific workflow that you need to solve for. I think that's where we get into more of a new product design, something that can leverage some of the technology that we have, but would be really a new product, and that's when it starts to separate, if you will, a bit from our current commission manager tool. Yeah.
Sure. Right. Okay. Well, as far as the vote is concerned, your vote product, I mean, we're assuming the broker vote will continue to be an integral part of the research evaluation process. I mean, clearly there's more that has to be done under MiFID II, but our assumption has been that the broker vote will be the foundation for that. Is that something you're seeing?
Yeah, I think we're more than assuming. We're out talking to customers every day that use our current vote and prospects that are contemplating using our vote as part of that process. And it's our opinion, based on what we think are pretty informed conversations with customers who are trying to figure this out and how to position themselves to meet MiFID, that they're going to need an evaluation process, and they're going to need an evaluation process whether they're paying for research out of their own P&L, whether they're funding research directly, whether you're still using enhanced CSAs. At the end of the day, they're consuming research, and they're funding that research in a variety of ways, and they're going to make sure, and each organization will need to have a process of evaluating content, evaluating the effectiveness of that content, and evaluating the process by which their organization is consuming that content. And a vote system properly designed and implemented and distributed internally can help any asset manager through that overall process. And it can evolve into more of a budgeting tool. It can evolve into more of a tool that will help the buy side better collaborate with the sell side around how the sell side prices research. So it can almost become a tool to drive collaboration around pricing, as opposed to the way many customers use BrokerVote today is more of an allocation of a commission budget, as opposed to a price discovery or a content discovery / alpha discovery tool. So the BrokerVote is, I think, at the core of this overall process, and clearly in the MiFID rules, there's going to be a lot more responsibility and onus on senior management of the average buy-side organization, that they have a written policy and policies and procedures in place around assessing not only the quality of the research but the effectiveness of the research on client portfolios. And an evaluative tool like Vote can certainly play a significant role in all of that.
Right. No, I think, that makes total sense. Good. There seems to be also a lot of focus on metrics around usage, and obviously your calendar product, helps to meet that need.
Right.
I guess, what's your perspective on metrics, and to what extent are usage metrics? To what extent will the buy side rely on the sell side for usage metrics? Because many sell side firms are doing that, or collaborating with providers that offer usage metrics, or to what extent will the buy side feel that they have to develop those usage metrics internally?
That's yeah. So I think based on the conversations we've had, there's a little bit of both going on. And I think as time evolves and processes get refined, I think we'll come to a standardized approach across the industry. But because it's early days still in this process, there's a lot of evidence of firms leveraging the sell side and its data for a lot of this consumption tracking kind of data. It gets pushed, to the buy side, and then the buy side plays more of a validation role around those sell side statistics, and then ultimately come to an agreement on what that consumption pattern looks like, and then the next level down would be, okay, based on that consumption pattern, what are the items that we actually valued on the buy side and are willing to pay for? And the sell side through that process has gotten a lot of feedback as to, all right, what does each individual customer value, and where am I able to, charge, and where am I not? And in that process, depending on the sophistication of each individual sell side firm and their ability to push this data, that really drives whether or not the buy side is capturing their own data or not. So ultimately, at the end of the day, what I keep going back to is that the buy side is ultimately responsible for capturing all of this data, and to the extent they're not getting the data from a research counterparty that they need, then they are going to need to track that kind of pattern internally to make sure that they have the requisite amount of data required to make a decision around effectiveness and value. So right now, we're seeing that there's a bit of both going on, and in a perfect world, all of that data, will be sort of collected and standardized and cleansed in a more of a streamlined and industry sort of formatted way. but right now, it's just not there yet. And I think there's some work on the sell side to do there in terms of tracking this type of thing.
Mm-hmm. Yeah.
And and ultimately, we're seeing customers who are probably more thoughtful about best practices than some others who are sort of filling in those gaps a little bit more proactively than others, by leveraging some of the tools that we provide so that they have a much clearer picture and a consistent picture across all their counterparties as to what they're receiving, what they value, and ultimately what they're willing to pay for.
Right. Okay.
And the last thing I'll say on this is that the more that this data gets collected and standardized and shared, and the buy side and the sell side are in a better position to collaborate around, again, consumption patterns and how the buy side values the services that the sell side's providing, the better and easier it's going to be for price discovery at the end of the day for the sell side to make a distinction across customers as to how they're going to price various levels of services and various level of customer engagement, et cetera.
Mm-hmm. Good. That's good. That's excellent. Good. So, where do you think this comes out for sell side research? I mean, do you think that this is ultimately a negative for sell side research, or neutral or positive? I mean, what do you think is going to be the impact on?
Well, when you say sell-side research, there's a lot of people, a lot of players, a lot of actors in sell-side research. You have the bulge firms, you have the independents, you have the boutiques. So I would position them all in the sell-side research category. And I think when you look and drill down into each of those subcategories, I think there will be winners and losers, and there will be disruption. There will be competitive forces that will be in play that will sort of help certain business models and maybe hurt others. And a lot of that remains to be seen. I mean, I do have a few opinions on the topic. The first opinion that I'd be willing to share is the challenge for what I'll call the bulge bracket, integrated broker research platform. So these are the big bulge firms, top 20 firms around the globe that historically have covered, pretty much every industry, have thousands of companies under coverage that provide that big, a research coverage vehicle that the buy side has been able to leverage. The challenge in that business model will be that under MiFID, since everything is really driven off of a budget, and generally speaking, that budget cannot increase, without jumping through a few hoops and, changing, sort of agreeing with the client and changing your budget and then sort of, building that increased budget into the following period. There's some resistance, if you will, built into the system to make the budget very flexible. And I understand that's one of the core pillars, if you will, of the MiFID regulation or directive. The challenge for the sell side is that, in effect, your research revenue, the revenue that the firm can garner as a result of its research product, is capped. Okay, maybe not a hard cap, but there's a cap. And in an environment where research coverage on that scale is a very expensive proposition and requires the ability for outsized performance to be coupled with an outside return based on a response from your buy-side customer that you've delivered a great research and an effective research idea to, there's no mechanism, or it's very challenging in this new environment to see a great research idea and an alpha-generating idea immediately be, sort of compensated for, like it was in sort of the old model, where in effect, those two things were linked. Obviously, we're delinking that, and the problem I see is that that very expensive model that does depend upon superior research performance being compensated in a like for like kind of a trade no longer really exists, and therefore, without those spikes in revenue generated by great research ideas, that sell-side business model, I think, is going to be challenged because you're now, it's more of a fixed cost sort of, allocation model, and it will be very challenging for the sell side to support, these significant costs associated with, global research coverage. So that's one, I think, challenge for the sell side. In sort of the cap that I believe that this new regulation sort of puts on, and I think that potentially historically, and this may expose a little bit of my own bias being involved in this business as long as I have, but ultimately I believe that does align everyone's incentives, because if you're a sell side firm and you deliver a great research idea that generates a tremendous amount of alpha to the buy-side asset manager, who then delivers performance to the customers whose portfolios increase in value, and then the sell side is rewarded with increased, commissions or an increased, more of a revenue to that firm that provided that great research idea. Everyone's incentive is aligned, right? The sell side's really axed to perform well, to deliver performance. The buy side is always in search of alpha. They want to work with the firms who deliver the best alpha. And once alpha is delivered and performance is generated in client accounts, there's a real justification to pay that firm, in effect, more revenue than maybe you would have budgeted normally because of the great research they've delivered. And that aligns everyone's incentives. And that's the problem I see going forward, is that there's not a lot of incentive built into the system to let free markets, really, drive the sell side to deliver performance and the buy side to have the freedom to really compensate the sell side for a job well done. That becomes a challenge under this new methodology.
Right, I hear you.
So, and then when you move down into the other categories, when I think about the independent research firms, who have more historically not relied on transactions to compensate them for research, and they have a little bit more of a fixed price model in their research delivery, they actually may be, neutral to slightly positive, because they may pick up some of the slack that may be the result of the pressure that the sell side traditional bulge model will be under. So you could see a bit of an increase in sort of that independent boutique type of research firm who traditionally has had fixed price on his or her products. And then beyond that, you probably, like in every case where there's been significant regulation, there'll be innovation and other models that might crop up that may solve problems and fill gaps, and obviously necessity is the mother of all invention, and there's likely to be some innovation that builds into the model that remains to be seen whether it fills the gap completely or just creates other problems and other unintended consequences that we can't foresee.
Right. Thinking about the sell side as a whole, as you do, incorporating, the bulge and the mid market and the independents, what do you think is the overall net effect on research spending? Do you think it's going to be going up, down, sideways?
Yeah, I think if you just look at if everything remained the same with respect to well, let me scratch that. Let me start off by saying that based on the fact that we know certain significant customers have decided to opt out and pay for research out of their own P&L, it's likely the next step for those firms will be, you know what, since we're paying for research out of our own P&L, there may be a cheaper way and a more efficient way for us to develop and utilize and consume research, which then leads them down to the next path, which is, maybe we should just hire our own research staff. We should just bolster our own internal capabilities. And when you see, as I predicted, potentially a higher percentage of firms opting out than maybe some have expected, and the next logical step for those firms is to think about insourcing research more proactively than they have historically. And just that alone will drop the amount of research that, the amount of research spend, if you will, that will be, available or that will be demonstrated in the market.
Mm-hmm.
So I say based on that alone, my prediction would be that, explicit research spend will drop. Not sure how much, but it should drop.
Right. Okay, got it. Excellent. Well, Tom, those were my questions for you. Are there any questions that I should have asked but didn't?
Oh man, I'm thinking what would be. Yeah, I think the only other thing that maybe you should have asked that are sort of the wild cards. Like what are the potential wild cards here? And although these are all low probability events, I think there's some political risk in all of this. When you think about the Brexit thing coming up in June on June 23rd, if that actually happens, what does that mean for this MiFID regulation? What does that mean if the UK is kind of on their own? And then what happens if, as a result of the UK opting out of the European Union, just do France and Germany follow? And if they move, does that break down ESMA and break down, all of these regulations that are aimed to pull everybody together under one framework? I mean, that's one sort of political curveball that could occur in all of this. At the end of the day, the other wild card is that, if the feedback continues to come back that these regulations are so onerous, they're unworkable, that you're really just going to get this massive opting out, and everyone's going to try to figure out how to pay for research out of their own P&L, which at the end of the day makes Europe maybe a less competitive market than other market centers that aren't dealing with this onerous regulation. That creates an anti-competitive pushback, and perhaps, small chance, maybe the EU votes this down. So there's wild cards that could really derail all of this. Obviously, very low probability events, but I think worth noting and worth at least putting out there for folks.
Yeah. No. Agreed. No, that's good. No, thanks. All right. Well, good. So off the
and
record,
I think and Sandy, and that would be a theme that I think overall, like, we should be highlighting to folks. I mean, if Europe goes through with this and some of these unintended consequences play out, which makes maybe the business model to operate, if you're an asset manager in Europe, much more challenging than if you were located somewhere else, whether that somewhere else is Dallas, Texas, or Singapore. Is there, fundamentally, are there fundamental unintended consequences as a result of this that could, over like the long term, we're talking like 10, 12, 15 years, let's say, after the dust settles and everything, where there's almost like an incentive for asset managers to set up shop, outside of Europe, where the regulations are a little bit more, what I'll say, more free market friendly. And that over the long term, I think would be, if it did play out that way, I really don't believe that was the aim of the regulators, right? And that could be one of the massive unintended consequences where it just kind of kills the industry. And when you think about Western civilization and one of the industries that we really lead, it is financial services, and there's a ton of transparency already and a lot of efficiency in Western markets, and we're tinkering or potentially messing with a system that works really well. And that's my biggest concern, is like, are we potentially putting this great industry in a position to to be, sort of competitively swept up by other countries and other economies.
Mhm.
I'd be very concerned if I were in the EU on that issue.
Mhm.
So,
Okay. All right.
and what was the last thing you were going to ask me? I'm sorry, I cut you off.
No.
Yeah.
That's good. That's all good. All right. So I'm going to turn off